Well, good afternoon then, everyone, as we head into a fresh week of trading on Monday, the 17th of July. We'll flick across the calendar, see what is coming ahead up over the course of this week. Now, we do have earnings season kicking off slightly into the back end of last week and into this week. We've not had much of the heavyweights out yet so far. A lot of them are due next week. So this week's not the busiest in terms of the earnings, so we won't cover too much of it on this session today. It'll obviously be interesting to see how companies are faring over the first or second, should I say, quarter of this year. Now, that could drive some positivity across stocks. It could drive some negativity across stocks. We did see a raft of positive earnings reports out of Q1, which did spark some upside in stocks. Now, that would more positive earnings releases would give more kind of thought to the soft landing narrative that is going through markets this week. So we will have to keep an eye on these earning reports. Do we on average get higher than anticipated earnings reports, where that further fuels the talk of a soft landing, that the American economy can have a soft landing? And the effects of these interest rate hikes do not cripple these companies to a point where they really start to struggle. So we are likely to see a raft of positivity if we get a raft of positive earnings reports. But again, that is not so much for this week, but into next week. But we do have a number of companies out over the course of this week, mainly banking stocks, to keep an eye on this week. Apart from that, we've had a negative, so slightly negative start of this week with some growth figures out of China this morning. Now you can see the GDP print for the yearly figure since Q2 of last year, actual 6.3 versus a consensus of 7.3. So slight bit of negativity to start the week, sparking a slight bit of a pullback across stocks and across the dollar as well, which will jump over to some charts now and we'll have a look. Obviously, we had substantial downside in the US dollar last week, the biggest weekly drop in the price of the dollar over the course of this year. We can see Aussie, Kiwi, Euro and Sterling all rallying higher. We can see dollar Swiss, dollar yen, dollar CAD all pushing lower pretty aggressively. Now, you're likely to see some sort of a bounce back, I think, this week, certainly initially. If those moves don't continue forever, they don't continue at that speed forever, so we will have to see a bit of a pullback at some point. I don't like trying to call tops and trying to call bottoms in terms of, oh, we should have a pullback now, but market looks a bit overstretched, certainly in terms of the US dollar at the moment. So something I'm going to keep an eye on, for some potential downside, certainly to start the week, or some potential upside, should I say, to start the week in terms of the US dollar. The flip side, in equities, you can see the S&P, the Dow, the Nasdaq and the Russell all having solid upside last week. The Dow, the FTSE, both having solid upside this week. In quite remarkable contrast to the week before, we can see the DAX massive downside, the FTSE massive downside. Nearly retraced all of those moves, certainly has done on the DAX. You had a bit of downside across the S&P and the Nasdaq, pretty aggressive downside in the Dow Jones last week, but then the week before last, and then into last week, all that was reversed and then pushed higher. Off the back of that weak inflation print on Wednesday that we saw, again, further fuels that narrative that the Fed are going to stop hiking interest rates. One more and done is what markets seem to be pricing in at the moment, and that has been taken as a positive over the course of last week. We can have a look at bond yields, so some substantial bond downside in bond yields, certainly across the US side of things, with the 10-year yield, down from kind of 4.1 the beginning of last week down to 3.75 at the end of last week, or certainly on Thursday. So a good 4 days of solid downside in yields, which is upside in bonds. Same thing across the 2-year. The Germans haven't really replicated that. The UK haven't really replicated that. Some downside in line with their US counterparts, but not a one-for-one correlation. So pretty aggressive downside when it comes to US yields, but that is to be expected with those weak inflation prints and markets pricing out interest rate hikes, or kind of pricing in the factor of no interest rate hikes at their September meeting. So we got the Fed to work out next week. Have a look at next week. We're expecting one more interest rate hike from them, and for them to then be done. Apart from that, it's kind of what we're looking at. Like, do we expect a bit of downside in stocks? Never like calling that personally. I'd rather just be long, even if you're somewhat sort of delusionally long. Sometimes when there's an uptrend, markets will find any sort of reason to buy stocks if they can. Those earnings reports do come into focus as we head on into this week and into next week. So something we do need to take into consideration. Maybe a slight bit of sideways price action until we get some earnings releases out. may make for some difficult trade into today. But a bit of a pullback in the dollar, a bit of a pop higher doesn't seem unreasonable. If we have a look at the chart here, across this 101 level, seems a decent bet for a bet on a pullback. These lows that you had all through here, and then these lows posted back in February of this year, mean that is a decent level to look for a pullback back into. And certainly, by the way, last week moved, certainly in terms of a charts perspective, wouldn't be completely out of the realms of possibility, especially if that negativity from China fuels into the rest of the week, or kind of finds its way into the rest of the week. That is maybe a reason for a bit of a pop higher in relation to the dollar. We did have a slight bit of a pop higher, a bit of an excuse for a bit of a pop higher on the New York Empire State Manufacturing Index, beating consensus this week, or today, sorry. Retail sales tomorrow. I think these numbers, these numbers are important as we head on to this week. These retail sales figures out of the US, obviously consumer spending figures, can give us a bit of a fresh impetus when it comes to the US dollar. Now, kind of some negative numbers can fuel that kind of suggest that the Fed will stop hiking interest rates. Let's see if it get too bad, but then that is obviously negative for markets. But a slight bit of a miss on consensus, probably what markets will hope for a bit of a rally higher in stocks. These Canadian inflation figures tomorrow, with the central bank, the Bank of Canada, suggesting they are no longer going to hike interest rates moving forward. I think a miss on expectation probably continues that US dollar CAD. Talking about the Canadian dollar, probably sparks a fresh wave of selling across the Canadian dollar. That is the trend across the board on the Canadian dollar at the moment. But on the flip side, a bit of a spike higher will keep the central bank thinking, and maybe that's worth paying attention to in either direction once we get those figures out tomorrow. This inflation print when it comes to the UK on Wednesday is pivotal when it comes to the Bank of England. Now, a beat on consensus means they definitely need to keep the foot on the gas. I think a miss on consensus probably slightly more difficult to trade. If that comes in 8%, now still that rate of inflation is still far too high for the economy to handle going forward. We can see this core CPI print consensus bang in line with the previous month as well. So a bit of a beat on that core CPI print and a bit of a beat on the headline figure means the central bank need to keep the foot on the gas. Should be negative for the FTSE and probably positive for sterling. Now, in terms of sterling, I mean, the longer inflation remains sticky and the less able they are to get it down, that has its problems. That does have its problems in the way that the further they hike interest rates, the worse it's going to be for the economy going forward. So it's a pretty difficult one to work out in terms of sterling, but I think higher than anticipated or higher than consensus print is pretty negative for the FTSE, whatever way you try and spin it. Another thing of note, later on in the week, we come around to Japanese inflation on Friday. Now, previous 3.2, consensus 3.5. Now, the longer that continues to trend higher and continues to push and beat consensus, means the Bank of Japan have got more and more to think about in terms of inflation rising higher. They do have interest rates at negatives. They are still, continuing to do QE, and that 10-year yield is still anchored below 0.5%. Now, that was the reason for a lot of Japanese yen downside, as these other bond yields across the world were rising and causing a widening yield differential between the rest of the world's economies and the Japanese yen. As that continues to unfold, though, as inflation continues to rise in Japan, the Bank of Japan surely have something to think about the longer that continues. I mean, if I go and have a flick here and look at these prints here, obviously it rose, as you can see, or had been rising kind of all the way through the back end of last year, then had a bit of downside in line with other economies, but now you're expected back up to 3.5. That does get above 3.5 and starts to trend higher again. Something worth paying attention to, I would definitely think, as we head into the coming prints. That is May's release. Now, June's release is 3.5%, or consensus for 3.5%. You can see back here, June of last year is 2.4, then 2.6. This is when it was rising over the course of last year. Now, if inflation over the next couple of months in Japan, in terms of the year-over-year figure, starts to trend back higher again, it's trending back higher above all of these prints here, which again is worrying in terms of inflation beginning to get out of control in Japan. You can see these May figures, actual 3.2, consensus 4.1. So a bit of a miss on consensus in terms of the May figures, but we're expected to tick up higher from that. So I think we can disregard last month's figure in terms of where they got that consensus from. Obviously they do their calculations, but if we can get in line with that consensus this time and push above that 3.5 and beat consensus, surely that sparks some upside in Japan and gives the Bank of Japan something to think about. Apart from that, it's kind of where we're sat over the rest of this week. Not the busiest of weeks in the economic calendar. Few earnings reports to come out, then we get a lot more as we head into next week. But the charts will be important. Your cross-asset correlations will be important this week. Not a lot of fresh fundamental drivers to kick markets into gear. So we can look towards those charts, look towards those assets correlating off each other, and we'll see what type of direction we can get over the course of this week. But we'll be sure to update further as we head on through the week. So keep your eyes peeled across the social media channels, and we will update as and when we can.